All right, let's dive in. Today, we're talking about one of the biggest moments in any company's life, going public. It's the ultimate corporate glow-up, going from a private idea to a name you see on the stock market, raising billions of dollars in the process. So how does that actually happen? Let's follow the money and map out that journey.
Have you ever really thought about it? You see a name like Uber or Airbnb just pop up one day, and suddenly anyone can buy a piece of it. How does a company make that leap from being a private dream to a public reality? Well, that's exactly the journey we're going to take right now.
So here's our game plan. First, we'll stop at the big decision point. Why even go public in the first place? Then we'll travel down the main highway, the classic IPO. After that, we'll check out a couple of the newer, faster routes, SPACs and direct listings. We'll even take a peek at the private backroads before we zoom out for the big picture.
You know, every company that gets big enough hits this exact moment, this crossroads. They've got a great product, they're growing like crazy, but to get to the next level, they need a massive amount of cash. And often, that means going public. But man, this decision is a huge trade-off with absolutely incredible rewards on one side and some pretty serious risks on the other.
So what's the actual deal here? Well, the upside is obvious. You get access to this insane ocean of capital. We're talking way more money than you could ever raise privately. Plus, your early employees and investors can finally cash in their shares. But the downside? Oh, it's a big one. It's incredibly expensive. Banks can take up to 14% of the money you raise. And from that day forward, your company lives in a glass house. Every single move is scrutinized, and all your competitors get a front row seat to your financials and your strategy.
Okay, so let's start with the big one, the route you've definitely heard of, the initial public offering, the IPO. This is the traditional, the time-tested, the most famous way a company steps onto the world stage and offers its shares to everybody for the very first time.
An IPO is really the grand debut. It's like a debutante ball for a business. But this is no party. It's an incredibly grueling, super complex marathon of a process, and it's all overseen by the SEC, which is basically the toughest referee in the entire financial world.
And when I say marathon, I'm not kidding. A typical IPO takes anywhere from 6 to 9 months to pull off. It all kicks off with picking your partners, these big investment banks called underwriters. Then you're in for months of insane paperwork for the SEC, a marketing tour to sell the stock to big investors, and only then do you get to finally price the deal and see your company's name start trading.
So this underwriter, usually a massive investment bank, is basically your guide on this whole journey. They have 4 main jobs. First, they help you structure the entire deal. Second, and this is the key part, they actually buy all the shares from you. Third, they turn around and sell those shares to investors. And finally, they stick around for a bit to help manage the stock price and make sure it doesn't go totally haywire on day one. And this is where that name, underwriter, really clicks. See, in what's called a firm commitment, the bank doesn't just help you sell the shares. They literally buy the whole block of stock themselves. They are writing a check for hundreds of millions, sometimes billions, betting that they can resell those shares to the public for a profit. It's a massive risk for them, and it's exactly why they get paid the big bucks.
Now, this leads to one of the wildest quirks in the whole IPO process. On average, an IPO is priced about 17% below where it starts trading. Now, that means the company is technically leaving money on the table, but it all but guarantees that famous first-day pop in the stock price. It makes the bank's job easier, rewards the first investors who got in, and creates a ton of positive buzz.
But hey, the world moves fast, right? That long, expensive IPO, it's not the only game in town anymore. Over the last few years, a couple of new, alternate routes have gotten super popular, offering a much faster and sometimes way more direct path to the public markets. Let's talk SPACs and direct listings.
Okay, first up, the SPAC. The easiest way to think about it is like this. Imagine a publicly traded treasure chest, literally stuffed with cash, and its only mission in life is to go out and find a great private company to buy. For that private company, merging with a SPAC is a huge shortcut to the stock market. It lets you skip a lot of the traditional IPO headache.
Then you've got the direct listing. This is kind of the DIY, punk rock approach to going public. A company basically just unlocks the doors and lets its existing shareholders, like the founders, the employees, the early investors, sell their shares directly to anyone on the stock exchange. There's no underwriter, no roadshow. You just flick the switch and let the market do its thing.
This table really just lays it all out. You can see the IPO is the slow, really expensive option. SPACs and direct listings, way faster. A direct listing is cheaper, and you don't dilute your existing shareholders as much because you're not creating new shares. But look at that last row. Pricing.
That's the real game changer. With an IPO, the bankers set the price. With a SPAC, you negotiate it. But with a direct listing, it's a true, live auction. The price is whatever the first buyer is willing to pay.
All right, so not every big money deal happens out in the open with a bell ringing at the stock exchange. There's this whole other world of fundraising that happens behind closed doors. Quiet deals made directly with a very select group of investors.
This is what's known as a private placement. It's basically a secret fundraising round where a company sells shares directly to what are called accredited investors. Think big venture capital firms or super wealthy people. You get to skip all the public paperwork and the scrutiny, but the catch is that those shares aren't liquid. You can't just go and sell them on the stock market tomorrow.
So what if a company is already public but needs a bunch of cash, like yesterday? That's where a PIPE deal comes in. Instead of doing another slow public offering, they can just make a quick call to a big private equity fund and sell them a huge block of shares directly. It's kind of like a secret high-speed refueling station for companies that are already on the stock market.
All right, deep breath. We have been all over the map, from the 6-month IPO highway to the speedy off-ramps and the quiet backroads. So let's pull everything together and just focus on the big picture takeaways from this whole journey.
So what's the bottom line? First, just remember that going public is always this massive trade-off between getting access to huge amounts of cash versus giving up some control and privacy. Second, the traditional IPO is that time-tested but slow and expensive grand entrance. Third, these newer options like SPACs and direct listings are all about speed, but they each have their own unique risks. And finally, never forget that some of the biggest deals in business happen quietly, far away from any stock ticker.
You know, what's just wild to think about is how fast this is all changing. For basically 100 years, the IPO was the only way. Now you have all these new options, and the playbook is literally being rewritten as we speak. It leaves us with a really fascinating question to think about. As finance and technology keep evolving, which one of these paths, or maybe a new one we haven't even seen yet, will be the one that the next great companies choose to take?